It's one of the longest standing debates in our industry. Are we at peak gold or not? Joining me now is Cal Everett. He is the president and CEO of Liberty Gold, and he has an interesting take on this subject. Welcome to the show, Cal. Are we at peak gold?
The declining production curves of the intermediate major producers is rolling over right now. And you can see that on a quarter-by-quarter basis. Every time a quarterly earnings report comes out, I pay attention to whether they met their projected amount of ounces, what their cash cost per ounce is, and what their all-in sustaining costs are per ounce.
What led you to do this research and say, hey, I want to really start number crunching here, and how did you get access to the information?
I had got access to the information because I'm a geologist, but I'm also was a sell-side banker for 25 years. So I tie in with the capital markets, corporate finance side of all the sell-side firms, and I deal with them as they analyze our company, Liberty Gold, or every producer that has public records on, and I can get the information I need that they use in their business dealings. But this is not just an analyst for a brokerage firm trying to speak about one specific company. I'm assessing the entire industry.
So I'm really interested in this because, I've heard all spectrums of this debate. So make the case of why you feel we're really capped out here for production. Do the numbers just speak for themselves, or?
Yeah, the numbers speak for themselves. So after peak gold, I think it was $18.60 an ounce, the GDX was trading about $66. And now it's at about $19. So in a 7-year period, it's fallen by 71%. Yet the price of gold's fallen by 33%. So it's an oversell on the public companies, basically because people divorced their interests away from a sector that had a history of screwing itself up by bad corporate decisions when gold prices were lofty. And now the production numbers are falling from those companies. So from 2012 to 2016, they had to get their balance sheets in order. And by doing that, the average grade of a producing gold mine now has fallen from 2 grams to 1.54 grams. So the average grade of a producing gold mine is down by almost 25%. And they did that to increase production, to produce more ounces leading into 2018 by high-grading their deposits, to create the extra cash flow to get their average debt level for the industry down by 54%. That was number one. So their deposits are smaller. And at the same time, they stopped spending on replacing infrastructure in the operating mines by 58% on average for the industry. That money goes to buy new trucks and aging crushers and whatever else you need in a mine. And every 10 years, that has to get replaced. And that's why you're seeing, finally, it's biting them on their balance sheet that the all-in sustaining costs on average for the industry, other than B2 Gold and Kirkland Lake that I can review, is going higher and the margins are falling, but the production numbers are now rolling over because they're done high grading.
Okay, so from what I'm understanding what you're saying, it's just a series of problems and reasons contributing to this. It's not one factor.
They fixed their balance sheets, but they didn't fix their production profiles. So they let all the exploration die.
But the gold is there.
No, not necessarily, because the mines are smaller. They didn't find any new mines.
But, you and I attend so many of the same conferences. We see the number of exploration companies, the number of juniors. So why aren't they doing a good job of finding these deposits?
Because virtually all the geologists at a producing mining company are brownfields geologists. They're there to find more ounces to keep the mine operating. They're not there to do greenfields explorations. Right? So I had a meeting with one of the seniors the other day, and they're finally allocating 20% of their budget to greenfields exploration, finally, because the production pipeline's empty.
Here's the $1 million question for you, Cal. When are we going to start seeing this reflected in the price then, if there is peak production?
You got to get through a wounded market first.
More wounded than this?
I don't think it's going to change for a while because there might be 8 or 9 institutions in North America who can write a check for an exploration company. And the majors have a lot of cash, and they're looking at replacing their production declining numbers, because on average, the industry over the next 7 years will be producing 30% less ounces. So Barrick solved it. They took over Randgold, right? Pan American, brilliant move on Tahoe. Solved the silver issue. So the industry has to consolidate to get the missing ounces. The industry doesn't necessarily have to get it from the deposits itself, because no deposits have been found, or effectively very few.
So this might take a while to impact the price?
No, I think the price of gold is going to work its way up now. It's not. I don't really care about politics or or the US dollar, there's just not enough gold to go around. The production numbers are falling dramatically on average by 30%.
So when you're saying you could see a rise in the price of gold, what kind of targets? Back to the highs we once saw?
Yeah, the target I think is going to be a bit muffled because ore becomes waste and waste becomes ore with prices. Does that make sense? So in other words, if gold's at 1,500, something that didn't make money from 1,200 to 1,500 now turns positive free cash flow. So now some of the production can be restarted or another mine can come on.
So even though we are at peak production, it might not directly impact the price of gold per ounce.
It's got to, because if I can't deliver you the ounces, someone's going to pay for them to get them somewhere else, right? So if you go look at the global production numbers, it's China buys every ounce they produce. So we don't know what their numbers are. The Russians are the number one buyer of gold. Kazakhstan is number 2. Poland, the first European country.
Hungary and Poland this year, upping their,
are increasing it, and nobody's done that. But since Nixon got rid of the gold standard, 45 million ounces of gold were sold.
How does this all factor into Liberty Gold? Where does Liberty stand?
Oh, what Liberty did is we made a managerial decision, I would say 2-3 years ago, to stay away from jurisdictions that we thought were questionable on a geopolitical reasons. So we went after the low capex type systems, Carlin-style systems, that we really understand. So 2 of the last producing mines, heap leach gold mines in the world, were actually our discoveries.
And for our investors and watchers and viewers back home, you're in Idaho, Nevada, and Utah.
Yeah. And so we just select these targets that have large targets that actually made money in $300 and $350 gold. Then it takes us 2 years to reinterpret them, and then we drill them. So it takes 2 full years before we start to drill them, and we just keep finding another and another and another, right? We found Long Canyon, sold it in 2011 to Newmont for $2.3 billion. That mine is the 3rd most profitable mine in the Americas, with an all-in sustaining cost of $359 an ounce. So we know what we're looking for. And we have 3 of them in Liberty Gold.
Cal, I could talk to you forever. I appreciate you coming on.
Oh, my pleasure, anytime.
Continued success, and keep going with this research. I know a lot of people will appreciate it. Thank you so much.
Yeah.
And thanks for watching. We'll have much more for you on Kitco.com.